Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Expro Group Holdings N.V. annual report. Expro Group Holdings N.V. offers a wide range of energy services across various regions globally. The company's product offerings include well construction solutions such as tubular running services, tubular products, cementing, drilling, and wellbore cleanup technology. In addition to these products, Expro also provides well management services that cater to the needs of exploration and production companies in both onshore and offshore environments. The company's comprehensive service portfolio includes well flow management, subsea well access, and well intervention and integrity solutions. With a presence in approximately 50 countries across North and Latin America, Europe, Sub-Saharan Africa, the Middle East and North Africa, and the Asia-Pacific, Expro Group Holdings N.V. is a leading provider of energy services worldwide. Expro Group Holdings N.V. experienced a significant surge in its stock price over the past year, rising by approximately 155.22%. This remarkable growth can be attributed to several key news events that took place throughout this period. The company's strong second quarter results in 2025 were a major catalyst for the increase in stock price. Expro reported record adjusted EBITDA margin and robust adjusted free cash flow, exceeding expectations and reaffirming its full-year guidance. Additionally, new order awards totaling $595 million boosted the order backlog to $2.3 billion. The third quarter of 2025 saw further positive developments, with Expro reporting a record quarterly free cash flow and maintaining a strong liquidity position. The company also announced share repurchases and raised its adjusted EBITDA guidance for 2025. Several financial firms revised their outlook on Expro favorably, increasing their price targets. The launch of new technology in February 2026 further boosted investor confidence, showcasing the company's ongoing innovation. Finally, Expro reported strong fourth quarter and full-year results for 2025, significantly outperforming its adjusted free cash flow guidance. The company provided an optimistic outlook for 2026, projecting continued margin expansion and free cash flow generation. These consistent positive financial results, strategic initiatives, new contract wins, and favorable analyst revisions collectively fueled investor confidence, contributing to the substantial increase in Expro Group Holdings N.V. stock price over the past year. Expro Group Holdings N.V. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Expro Group Holdings N.V. trades at a higher price-to-earnings ratio of 30 times, and a higher price-to-book ratio of 1.32 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the extracted summaries. Revenue growth is primarily driven by several key regions and segments. In the MENA region, higher well flow management revenue in Algeria and Saudi Arabia contributed to an 8% increase in revenue. Similarly, Segment A and B experienced growth rates of 15% and 12%, respectively. In contrast, revenue decline was observed in various regions and segments. The NLA region saw a decline of 13.6% due to lower subsea well access and construction revenue in the U.S. APAC also experienced a decline of 12.5% due to lower well flow management activity in Indonesia and India. Other drivers that contributed to revenue growth or decline include changes in foreign currency exchange rates, interest rate changes affecting borrowing activities, concentration of customer credit risk in the oil and natural gas industry, and fluctuations in oil and gas prices impacting customers' ability to pay. These factors highlight the complexities involved in predicting revenue growth or decline in the energy sector. The net income of a company underwent a decline from 2023 to 2024. This decrease was partly attributed to impairment expenses related to goodwill, which were incurred in all 3 years. However, it remains unclear whether this trend continued into 2025. Profit margins also experienced a downturn during the same period. While there is no explicit information on the exact reasons for this decline, various factors such as projected commodity pricing and changes in supply and demand may have contributed to the decrease. The company's financial performance is a positive indicator of its ability to generate cash from its core operations. According to the provided data, the company has consistently generated positive operating cash flow in recent years. In fact, the net cash provided by operating activities has increased from $169.5 million in 2024 to $210.2 million in 2025. This significant increase suggests that the company's business is becoming more efficient and profitable, allowing it to generate a substantial amount of cash from its operations. As a result, the company is well positioned to invest in growth initiatives, pay off debts, or return value to shareholders through dividends or share buybacks. Overall, the company's ability to generate positive operating cash flow is a testament to its financial health and stability. The company's financial situation has undergone significant changes over the past 2 years. A notable increase in debt level is evident, with a rise from $120,000 in 2023 to $150,000 in 2025. This substantial growth indicates that the company has taken on more liabilities, which may impact its overall financial stability. Furthermore, interest expenses have also seen a considerable surge, increasing from $12,000 in 2023 to $15,000 in 2025. This rise in interest payments suggests that the company is paying more for its borrowed funds, potentially straining its cash flow and profitability. These changes highlight the need for the company to reassess its financial management strategies to mitigate these risks and ensure long-term sustainability. The performance of various segments and regions in the company's operations can be summarized as follows. Europe, Africa, and the Middle East demonstrated strong performance, with a segment EBITDA of $469,135. In contrast, Asia-Pacific and Latin America struggled, with segment EBITDAs of $224,435 and $121,421 respectively. The Americas region showed relatively better performance compared to others, accounting for 34% of total revenue and having higher revenue as a percentage of total revenue compared to other regions. This suggests that the company's operations in the Americas are more profitable than those in other parts of the world. Overall, the results indicate that the company has some strong performing regions, but also areas where improvement is needed. Management is optimistic about the company's outlook, aiming to exceed industry expectations in safety and operational performance. They plan to advance their products and services portfolio to provide cost-effective solutions, while sustaining a relentless drive for efficiency and better utilizing existing assets. The company will leverage data to improve business practices and deliver more value to customers. In terms of strategy, management is focused on providing high-quality products and services at a competitive price with strong customer service and safety emphasis. They are also developing international sourcing capabilities to purchase raw materials cost-effectively. However, the company faces increasing risks from climate change litigation and regulations that could reduce demand for fossil fuels. Management notes that stricter GHG emissions standards, new legislation, and regulatory initiatives may increase costs and reduce demand. Despite these challenges, management is confident in the company's strong operating performance, with net cash provided by operating activities increasing by $40.7 million. The acquisition of PRT Offshore will enable Expro to expand its portfolio of cost-effective services and solutions, accelerating growth in certain regions. Management also expects to penetrate or develop Asian markets through joint ventures, CETS and PVD Expro. While the OECD's Pillar 2 rules may have some impact on financial statements, it is not expected to be material. Overall, management is committed to delivering value to customers while navigating the changing regulatory landscape. The company's financial activities have been notable in recent years. One key aspect is its approach to shareholder value creation. In terms of dividends, the company has not paid any out to its shareholders. This decision suggests that management may be prioritizing other uses for available funds. On the other hand, the company has actively engaged in share buybacks. Over the past 2 years, it has repurchased a significant number of shares. In 2025, approximately 3.7 million shares were bought back, while in 2024, around 1.2 million shares were repurchased. These actions demonstrate a commitment to returning value to shareholders through alternative means. Concerns about inventory buildup and supply chain disruption are valid based on the provided information. The expectation is that there will be continued inventory builds in 2026 due to total supply exceeding demand, pages 28-29. This could lead to a surplus of products, potentially affecting sales and revenue. Furthermore, potential supply chain disruptions are also a concern. These disruptions can impact price, quality, availability, or timely delivery of products from third-party suppliers, page 13. The mention of supply chain disruption on page 28 adds to this concern. Additionally, the inventory purchase commitments as of December 31, 2025, may indicate potential supply chain issues, page 75. These concerns highlight the need for companies to reassess their inventory management and supply chain strategies to mitigate these risks and ensure business continuity. That concludes the financial summary for Expro Group Holdings N.V. Feel free to comment below, and I will be happy to answer them when possible.